Good morning, everyone. This is Darren Katz speaking. Really excited to be joined this morning by Ryan Mann out of the US to discuss the launch of our new Global Technology and Innovation Fund. Today's webinar should be approximately an hour in length, maybe a little bit longer, depending on how many questions we get through at the end of the session, the Q&A session. But please feel free as we go along through the webinar today to click on the Q&A button at the bottom of the screen and ask us your questions. We always enjoy the interaction and look forward to the questions at the end. So before heading into the presentation, please just take a look at the disclaimer on the screen. I know that it's always really difficult to read through that amount of text. If you can't actually read it or it's too small, really the whole idea behind the disclaimer is that today's presentation is not intended to be information specific to each individual person listening to the webinar, but rather general in nature. So please just treat it as such. For those of you who are new to TAMIM or who don't know too much about us, a quick introduction. My name's Darren Katz, and I'm one of the co-founders and co-CEO of the business. Essentially, we're a boutique investment management business, and the idea behind the investment solutions we put in front of our clients is that we're looking to provide you with investments that will, number one, generate you a significant return over time, but number two, do so in a way that is slightly different to everything else that is in your portfolio, hopefully. We operate across equities, property, and credit. I won't spend too much time going through all of this today, but in the equity side, Australian equities and global equities, the Global Technology and Innovation Fund obviously falls into the global equity bucket. From a property perspective, we tend to invest into single asset properties, and on the credit side, we run a portfolio of private debt. So the opportunity that we're discussing with you today is very much a focus on global equities, and specifically global equities in the technology sphere. And it makes sense to just take a step back before we get into today's discussion and have a look and see what's actually occurred there over the past. Technology to us is very much an enabler of growth. And we think as technology and innovation occurs across time, you see a step up in growth across economies and therefore companies. Going back over the last 5 years, the NASDAQ to us is a good indicator of the technology segment of the marketplace. You've seen the NASDAQ perform exceptionally well. In fact, around about a 22% annualized return through that period. And again, remembering that through that period, we've seen both COVID as well as a significant shift in interest rates as a result of inflation, which resulted in a 2022 bear market, probably one of the worst bear markets we've seen in a long period of time. So some really strong performance coming out of the technology sector, and something that we're really excited about going forward. I guess very topical in terms of what we're seeing in today's market. When is the best time to have a look at investing into these companies and into this technology type boom? The one thing that we keep on reminding ourselves is that markets tend to cycle across time, and you'll have both good and bad periods through those market cycles. It's always important to stop and remind ourselves that generally over a long period of time, and we have data going back 80 to 100 years to look at, over a long period of time, markets tend to go up. And the one thing that we understand is that there will always be these periods in those market cycles where we have bear markets, and that's generally defined as a market going down from peak to trough of a move greater than 20%. You do tend to see these bear markets occur every 5 to 7 years, with the last one being 2022 for us. They do, however, tend to be very short in nature, around about 1.5 years on average, and they tend to be down roughly 30 to 50%, depending on what happens in that particular environment. The interesting thing is that the bull markets, on the other hand, tend to be significantly longer. They tend to last for around about 5 years, and you tend to see them moving up between 2 to 4 times across that period of time. So certainly to us, we've learned through the years that bear markets, although they feel painful and are not comfortable when they occur, are probably very good opportunities to get invested into the marketplace. But also, bull markets tend to occur over long periods of time. We're not saying that you will not see fluctuations and downdrafts in those periods, but certainly we think those downdrafts, again, are good opportunities to get invested. So with that, it's probably enough of me talking for the time being. I'm really excited to listen to what Ryan has to say today. Certainly, I have not heard this presentation yet and really am very interested in picking it up. Ryan, welcome, and thank you very much for taking time out of the day to talk to us on this one. I'll let you introduce yourself and looking forward to the presentation.
Awesome. Thanks, Darren, and thanks everyone for joining. So just as a quick background for those who don't know me, originally from Cleveland, Ohio, went to Georgetown, studied finance, accounting, psychology, went into investment banking, then equity research, and have worked at a few hedge funds. But the common thread across all of those is semiconductors. That was my focus across. So basically, my background is primarily in semiconductors and investing. Better lucky than smart to get into semiconductors. Quite happy I did right at the beginning of my career, but I didn't necessarily have the foresight to say how important they become to the global economy. But basically, all along, I've essentially been studying this confluence of world cycle setups, everything from technology to demographics to geopolitics, and how semiconductors actually tends to sit at the base of all of it. I love connecting seemingly disparate dots and effectively trying to simplify very complicated subjects. We could shift to the next slide. This is a quick background on the discussion points that we'll get into today. We could go to the next slide. I have a simpler summary, which in the spirit of keeping things simple, which I find my best decisions tend to be the ones where keeping things simple tends to be the most productive. So here's the simple summary. Who Aquavis and TAMIM have worked together to build this product. We delved into a bit of my background. We'll talk more about the background of this project overall, but as I've mentioned, we've effectively been studying semiconductors and the technological cycle for our whole lives. Why? Starting with why, the global order today is changing, which is basically driving an acceleration in targeted investments, specifically our focus areas of technology, energy, and money. What? We built a product to invest in and capitalize on this targeted investment in the changing global order and this world system. The change is happening right now. We're really in the early phases of AI as well as this global order shifting. And where? Here, you're in the right place. Shifting to the next slide. As Darren laid out, TAMIM's background, they've been an amazing partner for the multiple years we've known each other. Aquavis was created a little bit less than a year ago to effectively create these products that we're discussing today to capitalize on this effectively once-in-a-generation type cycle. As I've noted, we have deep experience in semiconductors and investing. We're really driven by solving complex problems and focused on independent first principles thinking. We believe there's a lot to be learned from observing and analyzing complex systems like nature and effectively translating those findings to analyze markets, industries, and companies. Jumping to the next slide to delve into our process a bit. So our process starts with the big picture, so seeing the world the way it is and where we believe it's going. So when you recognize what are the big sustainable trends that will span a decade plus, doing this makes investing a lot easier because when you're focused on these growth areas, there tends to be an abundance of opportunities that become a lot more obvious. Some growth examples just over the past decade, 20 years or so, cloud software, smartphones, the internet, and so on. These were all massive growth areas and provided a lot of opportunity. Today, on the technology front, we see the beginning of that wave with AI, which is a massive surfing opportunity for the next decade. Then, as we drill down, we find the overlap of our areas of expertise with these big themes. And as we'll delve into, we believe we're at an inflection point in history, which revolves around power. And the pillars of power that we've identified are technology, energy, and money. We'll talk about each of those separately. For example, critical supply chain reshoring is essentially now a national security imperative, and it pertains to all of these pillars. So what we're looking for is beneficiaries within all of these realms that have been that have these structural multi-decade tailwinds, which moves us further down the funnel into the universe that we're focused on, effectively the companies who benefit from any and all of these themes. Within this universe, what we do is we rank and tier every name based upon their moats, value creation, management quality, incentive alignment, along with many other features. And finally, getting to the bottom of the funnel, we use tools that we've built up from fundamental analysis to machine learning driven tools and so on to drill down to what are the best expressions today of these themes. So basically, what we end up with are names that make it to the bottom of the funnel comprise the portfolio, which typically consists of about 20 to 30 names. Shifting to the next slide, we'll get into the meat of today's presentation, which is why is there such an opportunity today? So I'll just quickly, if you want to read these, the world is changing. We're at a significant inflection point in world history, and our country and the world, the United States of America, has always been able to chart the future in times of great change. So that's Joe Biden. And then Xi Jinping, he's the president of the People's Republic of China. Right now, there are changes, the likes of which we haven't seen for 100 years. And we are the ones driving these changes together. He's talking to Putin. So as we noted, we believe we're at an inflection point in history, and something that happens roughly once every 80 to 100 years, which not coincidentally is about the span of a human life. When the leaders of the two biggest countries in the world agree that change is upon us, I think it's a good time to listen and understand what exactly they're talking about. So shifting to the next slide is how we kind of actually frame this global system backdrop. So we spent a lot of time studying cycles and the lessons of history. And one recurring theme is that human nature doesn't really change. So the result of that is history tends to repeat itself, but only in outline and in the large. That's from a Will Durant quote from The Lessons of History. So simplistically, things are cyclical. And what you see is these natural cycles can and have been studied across various disciplines, from finance to demographics and so on. And what we see today is that we are at a confluence of many of these cycles, from rising geopolitical tensions and a global power struggle, which is laid out in Peter Zeihan's book, The End of the World is Just the Beginning. He's effectively talking about moving from a unipolar world to a multipolar world, to aging demographics and increasing wealth inequality, as well as rising populism. That's Neil Howe's The Book, The Fourth Turning, which was published all the way back in 1996. But he just published another book called The Fourth Turning is Here, which was published last year. To over-leverage sovereign governments, which Dalio goes into great detail into navigating big debt crises in his study of basically all of the financial cycles throughout history. And then finally, as you look at things like the challenges to the world order, which we're clearly seeing today with China and Russia challenging the hegemony of the US, and David Murren lays this out nicely in his Life Cycles of Empire analyses. And then on top of all of this, technological change is accelerating, and we'll talk a little bit more about this in the coming slides, but Carlota Perez in Technological Revolutions in Financial Capital lays out the biggest tech revolutions in history and how they align with a lot of these different cycles. So the point here is we use these curated experts in their respective fields to effectively stand on the shoulders of giants. It allows us to understand the system we're operating in and better focus on our core competencies. And these bullets simply summarize our current global backdrop. So this backdrop, the confluence of it leads to, we'll go to the next slide here. What we see in history is the confluence of these backdrops tends to where the pendulum has essentially swung too far in one direction, it tends to lead to a swing in the other direction. So a reversal of many of the things that we've seen for the last 40 years, which entails rising labor and capital costs, energy costs, inflationary pressures, rising taxes, populism, conflicts, and so on. All of this is what we're seeing today. And as we move from this low entropy, peaceful world that we've kind of lived in, an ordered system, through a period of disorder, it creates a lot of opportunities. These periods can be jarring, as we've seen in prior fourth turnings, where they would consist of World War II, which was about 80 years ago, the Civil War, which was about 80 years before that, and the Revolutionary War, which was about 80 years before that. So I think the point of all of this is it's critical to have a roadmap and a plan so you can be proactive rather than reactive within these timeframes. Jumping to the next slide. So the point of understanding this global backdrop is to understand the incentives of the major actors. And the major actors in these global backdrops tend to be sovereign governments. And what they tend to do is accelerate investments in their pillars of power. So the pillars of power, as we've defined them, are technology, energy, and money. The current hegemon, the US in this case, and the challenger, with China kind of being the leader, must invest in and dominate these intricately interconnected areas to establish power. We've seen it time and again throughout history. Leadership in these pillars defines the winners of effectively the new global order. And what you want with each of these pillars, so on the technology front, asymmetric technological advantages. You've seen it throughout history with guns defeating swords, submarines defeating ships, CMOS semiconductors entering into fighter jets to basically create a technological advantage in the Cold War, to the development of the ARPANET, which eventually spurred the internet. Point is, this asymmetric technology leads to ideally deterrence, and this military tech then tends to proliferate into commercial usability. The energy side is fairly self-evident. You basically need energy independence and the ability to produce your own low-cost energy. And the monetary independence side, the ability to print your own currency and pay off debts in your own currency, is of huge importance. We'll talk about the details of all of these, but in summary, our strategy is to invest in where these hegemons are investing in, the musts. Moving on to the next slide. So the first pillar is technology. That's really the primary focus and will tend to comprise the majority of the portfolio. The others are really balancers within it, and as we'll talk about, are really enablers, and they are intricately connected, but technology is kind of our bread and butter. So I would say probably 70% plus of the portfolio. Moving to the next slide. So these quotes, while technology development has always been a critical defining force, and while it is well known that whoever wins the technology war wins the economic, geopolitical, and military wars, this has never been truer than now. And China and the US are the leaders and big adversaries. So that's Ray Dalio basically talking about how technological investment is not something that's a nice to have because it's a consumer app, but it's effectively a need to have. And so you know that these hegemons are going to effectively force this technological investment cycle, and they want to lead because followers tend to, come in second, and there really is no second within a global order system. And then, as the quote on the right lays out, it's from the National Security Council in the US. And so it's saying we must complement the innovative power of the private sector with a modern industrial strategy that makes strategic public investments in America's workforce and in strategic sectors and supply chains, especially critical and emerging technologies such as microelectronics, advanced computing, biotech, clean energy, and advanced telecommunications. Point is technology matters a lot, and we need to invest in and lead in the key areas to maintain and or expand power. And this strategy is effectively focused on the areas that are essential for nation states to invest in. The geostrategic priorities that the national security laid out is a good roadmap for things we'd be interested in. Jumping to the next slide. So now actually delving into where we think we are in terms of the next technological revolution. The age of AI has effectively begun. If you could see these charts, I think they're actually pretty useful in terms of understanding technological developments throughout history. So the chart on the left highlights technological revolutions throughout modern history as defined by Carlota Perez in her book, Technological Revolutions and Financial Capital. So as you can see throughout history, going from steam engine, railways, steel, electricity engineering, oil, and then to infotech, we're really entering kind of the sixth of the revolutions. And what we believe is semiconductors are the foundational enabling technology, and artificial intelligence is the next revolution. So it's semiconductors effectively are the base layer that enables artificial intelligence. And what you see with the chart on the right is these tech revolutions mapped against quadratic waves, which is another overlapping cycle in our global backdrop. And what you see is that each technology layer builds on the last. So AI could not have existed without the internet, cloud and storage, and so on. And high level AI is essentially the transformation of once useless data into useful information. And also, just with this kind of backdrop, it's helpful to take a step back and just understand what technology is. So, technology as a broader concept and its perception is always changing and evolving. The railroads, refrigerators, rotary phones, internal combustion engines, all of these were once classified as technology. But once these areas were completely proliferated, went X growth, and the productivity in the fields really stopped, they handed off the baton to another area of technology, or another area called technology at that point. And what you see is those areas that were once called technology became legacy X growth industries in their own subsector. And so what is classified as technology is always changing. And for our current purposes, AI is our technology area of focus. And we believe it's going to be sustainable for the next decade plus, which we'll talk about in terms of where we are in the phases and the transition there. But I think a general point is, given technology is always trying to drive productivity and growth, it's a great area to be focused on and investing in. And I think Darren's charts from earlier, just on the NASDAQ over the last 10 years, you could pull that back throughout history. And overall, technology tends to be a great area just because it's always focused on growth. Moving on to the next slide. So just reading this quote quickly, over time, AI will be the biggest technological shift we see in our lifetimes. It's bigger than the shift from desktop computing to mobile, and it may be bigger than the internet itself. It's a fundamental rewiring of technology and an incredible accelerant of human ingenuity. It's a pretty interesting quote coming from the CEO of a company that is essentially the biggest architect and winner from the internet. That's Google, and it's Sundar Pichai. As the title intimates here, we think it's early within this cycle. The chart on the left is a great illustration of these prior cycles. PC, internet, cloud, and so on, as well as their winners. And as we highlighted before, each prior technology continues to build on the last, which enables this cumulative compounding innovation, as well as potential for exponential growth. And as this slide or the image on the left highlights, we believe generative AI is really the foundation layer for this next cycle. And the chart on the right is quite informative as to where we are within. So it's really delving into the actual AI cycle. Looking through it, we're really still in phase one, which began late 2022 with OpenAI's GPT 3.5 and the scaling of ChatGPT. I think at that point, people began to realize that large language models had hit an inflection point in functionality. And what this did is it spurred the start of a huge CapEx wave by the cloud giants, notably Microsoft, Google, Amazon. And to best handle these AI workloads, the data center effectively needed to be completely rewired and re-architected away from CPU, which is general compute, towards parallel GPU compute. The major initial beneficiaries of what I'll say phase 1A of this AI core infrastructure build-out have been companies like NVIDIA, who's a leader in GPUs as well as related software, along with players like Supermicro and Arista Networks. The winners will begin to evolve as we move through this actual cycle, similar to how we've seen with internet and smartphones. But the winners, as you move to re-architect the data center and then shift to different workloads, will change as you progress throughout that process. Notably, networking is becoming a lot more important as inference workloads are growing relative to training workloads. So what I'll say is phase 1A is really focused on building out the data center and the infrastructure for training, which is what you need to do first for a lot of these large language and other AI-related models. And then you move on to inference, which requires a different type of chip as well as different networking approaches. So that's kind of the phase one and really where we are today. We got a glimpse of phase two with the Apple Intelligence Day. That's kind of a sneak peek into what it might look like. So what phase two will be is edge AI. It's basically adding intelligence to all of our unstructured data on our phone as an example of an edge device. The best positioned companies here will be those that have proprietary data as well as direct consumer ownership. And the second phase will lead to brand new product cycles. So for example, only the latest iPhones will have Apple Intelligence on them. So it's going to require you to upgrade if you want to actually use it. And then quickly, just on phases three and four, that's primarily where the applications will start to come in, as well as likely a whole new app store or some rethinking of it. This will apply to both consumers and enterprises. And what I think you'll see is phase three, or the initial iterations, will primarily be on the digital side. You can get those out a little bit faster just because it's primarily software. And phase four, which probably happens kind of simultaneous with a lot of phase three, will be focused on the physical. So self-driving cars, manufacturing robots. We'll talk a little bit more about that in some of the following slides. Moving to the next slide. So unsurprisingly, we think this is quite large, otherwise we wouldn't be focused on it. The development of AI is as fundamental as the creation of the microprocessor, the personal computer, the internet, the mobile phone. It will change the way people work, learn, travel, get healthcare, and communicate with each other. So that's Bill Gates. I think everyone probably knows him as the founder of Microsoft, but overall, we have a decent amount of quotes in here, and typically I wouldn't highlight these, but these are coming from people who in the past have recognized and capitalized on technological cycles and have a great pulse on waves of innovation and their impact. And Bill Gates, Sundar Pichai, Dalio, none of these people were talking about this as it pertained to flying cars or segways. So I think it pays to pay attention when these types are speaking about tech revolutions. And overall, I think simplistically, it is going to be very big. I don't trust anyone's projections or opinions on sizing today. They're just really guesses to make nice charts. But given how interconnected everything is today, and given the size of the industries that are going to be impacted, from things like transportation to manufacturing to energy, which are literally the biggest components of GDP, I have confidence saying that this will be measured in the trillions. It'll be pervasive, and it's going to create a lot of opportunity. Jumping to the next slide. The other point here is it's growing. And as we noted before, technological progress is cumulative. So current technologies keep building upon prior technologies, as well as their networks as a foundation. The result is explosive exponential growth. For example, I think both of these charts are pretty useful to just look at, but it took Netflix over 3.5 years to reach 1 million users. It took ChatGPT 5 days. I think these charts basically speak for themselves as to the power of compounding technologies. And it also highlights the power of distribution, which I think in and of itself is a powerful component of the concept of power. Moving to the next slide. So what is AI? The media has created a ton of buzz around it, and many at this point are scared to even ask what it is. Given our focus really on the first principles, what we do is we seek to decompose AI into its foundational elements to really better understand it, to better understand who benefits, what's the hype, what's real, who are the players in the supply chain, what are the real applications, and so on. And so the way we break down AI is into 3 major components: compute, data, and algorithms. Any player who has all 3 is incredibly well positioned. Compute is really the foundation layer. That's what we were talking about with that AI compute infrastructure, and it has to be built out and re-architected to enable any of the other layers. Semiconductors are really the base layer of this compute engine, and what I like to call the oil of compute. On top of that is really data as the next layer. So having proprietary quality data is critical if you want to glean any useful information. If you just have a bunch of garbage data, it'll be garbage in, garbage out. But it's when you actually have useful, really untapped data that you can turn into information that you can actually make better decisions, create products, and so on, that's when it becomes useful. So this data is then a critical input that goes into the algorithms. And the algorithms or data are basically the oil of algorithms per se. So simplistically, AI allows you to transform quality data into actionable intelligence with the goal of saving you time as well as energy. And the confluence of these three elements composes AI. And what we believe AI is going to be the foundation layer to build on, similar to smartphones and the internet, for the next decade plus. Jumping into the next slide. So who is involved as this entire ecosystem gets built out? On the right, I think you see a pretty good early version of the initial AI tech stack. I think this will probably evolve over time, but this was what I found to be the best and best visual of actually seeing kind of how it's laid out. And how you want to read it is really from bottom to top. So it needs to get built up from the bottom, and then you eventually get to the top. And it's also another way of basically visualizing from slide 17, those different phases. So phase one would be at the bottom and phase four would be at the top. So the early initial beneficiaries are really focused on that core AI infrastructure, which really pertains to that base layer on this slide labeled compute hardware. Notably, GPUs from the likes of NVIDIA and AMD, along with players who help manufacture like TSM, which is Taiwan Semiconductor, and players on the server side like Supermicro. For everything to work, basically you need to build out and re-architect data centers, which is analogous to basically laying out railroad tracks for a train. You can't, if you have a train with no tracks, it's useless. Same thing with this. Phase 1A is primarily been on the training side. Phase 1B is basically what we're just moving into right now, where you're moving away from just purely training towards inference. Inference being actually transforming data into useful information on an ongoing basis. It's like predicting the future effectively for what someone might do. And what you see with this is a whole new host of potential beneficiaries, a lot of which stem around the networking optimization side. We'll delve into a few of these later in the presentation, but some that are top of mind would be like Arteris, which is a semiconductor company, a semiconductor royalty company, kind of similar to ARM, but really on the networking side of things, which is really interesting. And it's a small cap company. And what you see with basically all of these is that doesn't mean phase 1A becomes useless. It just means that you need to keep building on top of it. And the next phase progression from there, as you move up the stack, are the cloud platforms, Amazon, Microsoft, Google. They're both spenders and beneficiaries. So at this point, they're massive CapEx spenders. What they need to do from there is create products that are actually useful. And as we keep moving up through these different modeling layers, you see where OpenAI would fit in. They have really the base foundation models, which are massive models. I think most of those end up becoming really like a utility. That's Apple's view too, where they have OpenAI integrated into the smartphone, but they've left it open for Anthropic or others to also kind of fill those gaps. I think OpenAI, obviously, they'd like to expand into an ecosystem with an app store. And so what they need to do is move both up and down the stack to control their own hardware, as well as have edge devices. Overall, this layer tends to dictate what type of compute layer you need. So if you need more training or inference and who you need within that. Again, then moving up, you basically have phases 3 and 4, which are digital and physical applications, AI agents like, an agent effectively booking a trip for you, to self-driving cars, to autonomous robots in a factory. So overall, the way I like to think about AI is it unlocks a lot of use cases around things like automation. And in doing so, it makes huge tasks like reshoring supply chains a lot more economical and feasible. Similar to how it was it was impossible for someone or for a company like Uber to exist before the confluence of the internet and the smartphone. There are going to be some previously impossible businesses that are created in the next decade. So basically, as AI gets built on top of effectively the internet and cloud, you're going to have automation companies that couldn't exist before because they effectively didn't have that base infrastructure. So we can literally do an entire presentation just on AI, but for the sake of time, we'll run through some of the other pillars, companies we like, and then leave some time for questions. So jump to the next slide here. I think, Darren, you mentioned this video wasn't working. If anyone wants to check it out, just Google Figure 1 OpenAI. It's pretty awesome, frankly, where you see effectively the emergence of these physical use cases when you pair advances in robotics with advancements in machine learning and large language models. And effectively, it allows humans to talk to and understand computers, and computers to talk to and understand humans. And that's a pretty powerful combination, which again, I think hit an inflection point about a year and a half ago. We'll jump to the next slide. So energy, we can jump to the next slide on it. Energy is another major pillar of power. If you just take it from its foundation, energy is effectively a critical input into any system. And what we like to call energy for our purposes is the base layer for both technology and money. And the most powerful nations are those that are energy independent, have access to low-cost energy resources, and have abundant supply of those resources to basically enable growth. Hence why, similar to technology leadership, energy is a national security priority. The US literally has something called the Strategic Petroleum Reserve, which is a reserve of oil for national emergencies. And as this chart highlights, the right, energy consumption is essentially a one-way train higher since the first industrial revolution, which is really the first technological revolution as we highlighted within those cycles. Each unlocking of new energy sources throughout time, coal, oil, nat gas, and so on, basically coincides with the jump in technological process. And as the Jevons paradox highlights, we essentially just keep consuming more energy as it becomes cheaper. What's a little bit ironic is technological revolutions typically require upfront significant investment in energy to power the revolution, but then the technology itself tends to make energy cheaper and more efficient, which is effectively productivity, and it inevitably creates these commodity boom bust cycles. We've been in an effective commodity bust cycle for about 20 years, and over the next maybe 5-10 years, there's an opportunity for a commodity boom cycle. And overall, it's why energy and its general supply chain tend to be cyclical and not great long-term investments, but they do act as nice diversifying investments to balance a portfolio, particularly when you understand the supply-demand backdrop. So jumping to the next slide, on the demand side, energy demand at the time when supply is not really growing anymore is beginning to meaningfully accelerate as a result of multiple secular trends happening at once in the West. So on top of the multi-decade plus trends as it relates to supply chain reshoring and electrification, AI will be a major driver of increased power and energy consumption. The result and point of all of this is simply that there's a lot of opportunities in this electrical infrastructure build out, and many of them nicely overlap with AI and the technology pillar. So they sit at the intersection of that Venn diagram. A few examples would be analog semiconductor players like Texas Instruments and Monolithic Power. So not only do these analog players have increased semiconductor content as you shift the data center architecture away from CPUs towards GPUs, but they also have critical roles in the grid and upgrading the infrastructure as it pertains to that, as it relates to power consumption. So power is one of the most important, basically, considerations as you're building these out. And so you really want the most efficient, both materials as well as analog players within it to enable the latest shift towards higher power related use cases, whether it's enabling your home to power your EV or upgrading the entire electrical infrastructure grid to actually be able to handle AI data centers. And another thing that's critical for all of this is just baseload energy. Solutions like nuclear and natural gas are great transition solutions, so things we're paying attention to. And we're also paying attention to incremental energy sources like solar, as well as storage solutions and technological innovations as it pertains to batteries. We can jump to the next slide. So jumping over to money, which you can shift to the next slide here just with the visual. I think money is often an overlooked pillar of power, particularly for people in the US, given how central the US dollar is to everything around the world. In the US, you don't really notice it because you use the US dollar, but for someone to use the US dollar when they're transacting overseas is a bit different. And the US is effectively in a uniquely powerful position with the US dollar as a global reserve currency, which is the foundation of the current interconnected global system, and US treasuries as the global reserve asset. But as we've highlighted, this current order is being challenged. And you see it every day with things like the BRICS currency development, as well as China and Russia net settling oil trade in gold. The chart on the left really highlights the potential shift from US treasuries as a core reserve asset, shifting towards gold. And as we've highlighted before, financing all of these technological innovations is going to require a lot of money. And this development of technology is essentially a must-have. It's a national security concern, not a nice-to-have. And so the spending really comes at a time when most major sovereign governments worldwide have relatively high debt to GDP. And if you combine that with the fact that the money that is necessary to spend on both tech and energy, I think monetary debasement is effectively, in the interim, seems inevitable. A lot of this is going to have to be monetized, and our view as a balancer within this portfolio is to hedge this monetary debasement with assets like gold and or Bitcoin, as well as their derivatives, as effectively we'll get into it in a bit, but technology plus energy plus money are, as we've noted, the pillars of power, but also create this kind of naturally balanced portfolio. Shifting to the next slide, just trying to make sure we have enough time for questions. This highlights where debt to GDP is in the US. It's close to 120%, spending $1 trillion a year just on interest. As you can see, this happens throughout history, and it tends to lead to periods of fiscal dominance, followed by monetary dominance, followed by fiscal dominance. And all of this tends to go in roughly 80 to 100-year cycles, and we just happen to be at a transition point. The resolution tends to be technological and or energy innovation, and or just shifting to a new world order. We'll delve a little bit more into this into the information memo, but suffice it to say, money is a critical component as it pertains to all of the pillars of power, and we recognize it as something that kind of fits naturally within the portfolio. Shifting to the next slide. So as I said, the pillars of power are this almost naturally balancing portfolio. They're all intricately connected. And our view is AI is the foundation layer for technology for this cycle. Semiconductors are the key building blocks. Energy and money are both needed to help enable technology, but technology over time should make both of them more efficient, which is why technology tends to be the best investment long-term, whereas the other two act as enablers and diversifiers along the path. And I know there's a lot of change going on cyclically and throughout the world, but as Neil Howe likes to write in his book, just as winter inevitably turns to spring, order will definitely follow disorder. And the greatest opportunities tend to present themselves during these transition times. So those who have actually studied history and are prepared and are proactive tend to be best positioned to actually capitalize on the opportunities. Shifting to the next slide. So just why now? Well, we're at an inflection point in history. I think we've got that point across in terms of the confluence of cycles, challenges to the current order, which ultimately just results in an acceleration in spend on these target investment areas of energy, technology, and really money. And these demographic and geopolitical waves are really tied directly into technological and innovation waves. Next slide. And then why now? We're also at an inflection point in markets. So what's pretty interesting over the last year, particularly the last few months, although it's starting to shift, the percentage of stocks outperforming the index is near an all-time low, while concentration in the S&P is at an all-time high, so higher than the .com. And the market cap versus equal weight correlations is near an all-time low, while at the same time, what you tend to see is equal weight tends to outperform over time. So the summary of this is the really large cap names are dramatically outperforming, And yet what you tend to see throughout history is the mid cap names tend to be the better performers over time, or really just the equal weighted index. And so our view is there's a lot of opportunity on the small and mid cap side, which is also where a lot of these phase 1B and phase 2 beneficiaries kind of lay. Shifting to the next slide, we can talk a little bit about a couple of these. So this slide highlights kind of the three pillars. The far pillar, if you're looking at it on the left, is technology. The middle pillar is energy, and the far right is money. Money, just really monetary debasement hedges. The middle section fits both energy players as well as those who are helping enable the build out of energy infrastructure. So players like Amphenol, who are critical as it relates to copper and other data connections, both for data centers as well as grid and electrical infrastructure. Monolithic power is one on the analog semiconductor front. And then the far left, which is really the crux of the portfolio, where we want to really see an overlap between kind of the energy and money. And so the energy and technology. And so someone who would sit at the center of that would be a player like Texas Instruments, who is a major company that is based in the US, is vertically integrated. It's an analog semiconductor company that's focused on building out its footprint within the US. So as we reshore and reduce our reliance on places like Taiwan, Texas Instruments stands to benefit. And their chips are used both in data center infrastructure as well as the build out of these new energy grids. I think the next two slides kind of goes into some of these names in more detail too. So Arteris, I highlighted a bit before, but this is a smaller cap company. It's a royalty company, so they have incredibly high gross margins, 90% plus. And what they're focused on, whereas ARM is really focused on compute, the Arteris solutions are really focused on the networking on a chip and the interconnect, which is going to be incredibly important in phase 1B of the data center build out as you shift towards optimizing networking as well as inference. And ARM Holdings trades at 20, 30 times sales. Arteris trades at like 4 or 5 times sales. So there's an opportunity, partially because they just haven't really been focused on as an area of flow. But I think based upon their pipeline as well as the solutions that they have, they're really well positioned as it relates to a lot of things as it relates to automation, but in particular the phase 1B of the AI infrastructure build out. And then last quick one just on Texas Instruments. I already really highlighted this, but the point is they are going through a massive CapEx cycle, and they are building out 300 millimeter wafer fabrication facilities. And we don't have to get into all the details about that, but most of the competitors in the landscape have 200 millimeter wafer fabrication facilities. And the shift in terms of your cost effectiveness as you shift from 200 millimeter to 300 millimeter is pretty astounding. So Texas Instruments, while on an upfront basis, is going through this CapEx cycle, which is depressing free cash flow. Coming out of it, which will be in late 25 into 26, they're going to be incredibly well positioned with the lowest cost solution, domestic fabs within the US, so clearly a huge beneficiary of reshoring. And they're also a beneficiary of things like the CHIPS Plus Act, which the US government is effectively subsidizing some of this. And that's not even really reflected in their financials. It's mostly a balance sheet item right now. So the net of it is they're major beneficiaries of a lot of the demand drivers. And on the supply side, they're dramatically changing their cost profile. So it's players like this that we look for that really have that overlap of the Venn diagram where reshoring beneficiary, AI beneficiary, and beneficiary of the electrical grid and energy infrastructure change. So in summary, I think last slide here, and let's get to questions. We believe we're at an inflection point in history in markets, and given this backdrop and our understanding of kind of where we are and the roadmap of what's ahead, and effectively the necessity to invest in these areas by the biggest spenders in the world, which are effectively sovereign governments, the opportunity to capitalize is there. And that's basically why we built this product. And yeah, I'll hand it off to Darren and we can get to some questions.
Ryan, thanks so much for that. I'm just going to get into the questions here fairly quickly. Just as I pull them up, certainly you can still type in some questions using the Q&A button on the bottom. If we don't get to all of them, we'll send the responses to you individually through the course of today. Please just be aware the product launches 1 August, which is next week. So if it is something that you're interested in, please speak to one of the TAMIM directors or myself just to get the information memorandums and the investment documentation. That is all open and happening as we speak. In terms of questions for the day, Ryan, I might just say to you, let's try and keep our responses fairly tight, sort of 45 to 60-second responses, just so that we can make sure we get through them. There's a fair bit here. So first one, generally always political. I think Australians tend to be quite interested in US politics. Obviously heading into an election period now in the US, and it's likely that, well, there will definitely be a change of president. What would, and I'll stay away from names, but what would a Democrat versus a Republican presidency look like in terms of the progress that's been made so far under Biden?
Yeah, it's a good question, and I'll try to keep it tight. I could talk about this stuff all day, as you can probably tell, but it doesn't matter in terms of what we're talking about in terms of pillars of power. Technology and AI is an imperative, and it's been recognized on the Biden front. Trump has talked about it from setting up Manhattan projects all around the US. So that is a no-brainer that will, I think, will accelerate basically no matter who's in office, which you also tend to see in second terms where they'll just do whatever they think is necessary because they're not worried about getting reelected. And then on the energy side, it could change a bit in terms of, you know, if you're not forcing things like, not even forcing, but if you're not subsidizing things like electric vehicles as much, that could lead to, a little bit of a blip. But what I think is interesting is if you look at just like an electric vehicle index under Trump and an electric vehicle index under Biden, Trump, it dramatically outperformed, and under Biden, it's dramatically underperformed. So I think the point is some of these things are just necessities, and the consumer recognizes things, the market decides if, and I mean, we believe this, electric vehicles and autonomous vehicles are more cost effective and a better technology than internal combustion engines, then they will get adopted. And I think there could be bumps along the way, shifting from Democrat to Republican there, but either way, you're going to see a lot of spend on both of those, which is part of the reason why the third pillar exists, where monetary debasement is kind of an inevitability.
Thank you. Two fairly tough questions. So this first one, innovation tends to have a lot of losers before the winners become apparent. How do you feel you'll be able to fare in terms of picking the winners in this next cycle?
Yeah, I think that's a really good point. And you've seen it. I mean, you've seen it very recently with electric vehicles. You had, I don't even know how many, but a ton of startups as it relates to EV OEMs. And realistically, we delved down into all of them and said, Tesla and BYD are the only ones that are going to exist. The rest are probably going to zero. The point of it is what you really want to invest in are the blue jeans to gold miners, trying to pick that end state winner. So trying to pick the Apple of this cycle, or the actual OEM who creates the vertical integration and the end application. That's going to be harder, and there's a lot of paths that can take. Whereas if you focus on the layers as we've laid them out and see who benefits no matter what the end application ends up being, but who benefits, who's selling the blue jeans to the gold miners. If you look at it, it's a lot of semiconductor companies. And what you want to look at is both semiconductor companies, not only in this first phase, so who's benefiting from the data center re-architecture as it pertains to training, but all right, who benefits as you shift towards inference and so on. So what you can really do is mitigate your risks by investing in what has to happen no matter what, kind of like the railroads have to get built. And then you start moving up as some of those things start to become a little bit more apparent when the applications start to launch and so on. So I have a view on who I think is best positioned as those end states develop, but I think the lower risk and frankly higher reward in the meantime are the players who really provide the picks and shovels.
Thanks, Ron. We're getting the tough ones today. So next question, why pick this fund versus maybe a passive ETF investing into the NASDAQ or technology?
Yeah, that's also a good question. And I think kind of relates to the prior question, which is there's probably going to be more losers than winners as you progress throughout this. And a passive ETF is not going to update those things. It'll just, it selects its investments and it just sits at that. And it probably grows incredibly concentrated in just a few names. And frankly, you actually see that in the indices today. I would not want to really be invested in the indices where you're basically just betting on four names. I see a lot more opportunity in actually selecting specific stocks beneath it that have largely been overlooked, partially because of this restrictive rate environment. We can get into kind of where we are within the rate environment and macro, if that's a follow-up question, and why I think actually SMID caps have an opportunity. But the long story short is, as this AI cycle progresses, the winners and losers are also going to change. And if you stay stagnant with holdings for phase one and you move into phase two, you could be left with big losers. And you're actually starting to see that already as platforms are changing in terms of who's designed into the NVIDIA GPU for Blackwell that launches later this year. And it's a whole host of new players that are very different versus those who benefited last year.
Thanks. I think probably does segue into that question. We're obviously in a changing rates environment in the US, and we've actually seen a fair change in US equity markets over the last 7 days, where there's been a sell-off in the mega caps. How does that interest rate cycle or potential change in the interest rate cycle impact on the areas you're investing into? And I think you've probably touched on that a little bit in your response there.
Yeah, and I think it's a little counterintuitive if you just think about it, just from a top level. But when you drill down into where the money is flowing today, the money, because interest rates are high in the US, the money is flowing to the people who already have money. So you used to earn nothing on your cash. Now you're earning 5%. What we saw on Google's earnings yesterday, they earned $1 billion in interest income during the quarter. If you look back like 3 years, that's zero. So there's that massive shift is basically being reflected in the market, where the winners of rising interest rates have actually been these large cap tech companies that have significant net cash. And the losers have been effectively everyone else who maybe they have some cash, but they're reliant upon financing, which is a lot of the small mid cap. So as you see the second derivative change, aka shifting from interest rate hikes to interest rate cuts, I think that should also help shift that dynamic. And you'll also tend to see it in areas like industrial capex, as well as the financing of things. So consumers, housing transactions are basically at an all-time low in the US. No one's buying a car really either. All of these things are because they're financed. If you start cutting rates, that'll change that. So anyways, I think that's what you're starting to see as the distribution of returns changes in the index.
Ryan, thanks so much for that. I think I'm going to call time on questions at that point. Thank you so much to everyone for getting onto today's webinar and listening to what we have to say. We're really excited about the space. Innovation and technology, as I said, drives growth and certainly improvements in business cycles. The portfolio or the investment opens for transaction on 1 August. So if you haven't seen the offer documentation yet, please speak to us and we'll get that across to you. The recording of today's webinar should be available within around about the next 24 hours. So that will be sent out, and certainly we will send responses to all questions that haven't been answered today through the webinar to all the people that have asked them. Thank you very much once again to Ryan and to all attendees. We look forward to talking again over the next few weeks. Thank you.